live from the city. This is the High Valuation Code with Matteo Turi.
All right, welcome everybody back to episode 7 of the High Valuation Code. We are into 7 weeks down the program out of 12 episodes. Today we are in group 2. We described what are the groups, so we are not going to go into technicalities now. But today I think it's a very important topic, which is the financial narrative that raise money. And we have plenty of meeting in the past week. We have plenty of stories to share with you, and also what is going on with those stories, why these companies are struggling to raise capital. So that is when the numbers and this, what we're trying to illustrate today is when the numbers that you are looking for and the stories that you're telling finally aligned to have a successful raise, right? A successful round. Now, each week, we explore how businesses move from fundability to valuation, right? From evaluation to scale and from the scale to exit, because there are 3 steps in the triangle. So over the last 2 sessions, we've been building the group 2, which is a framework of, and when started to the 3 things. The first was the founder detox. What this is in this particular group in the framework that we are working is the founder detox. Last week, we spoke about the leadership architecture, so how the architecture of the leadership works. And today we address something that sits at this intersection of both, because actually we have to bridge these concepts. Even when structure improves, even when leadership evolves, many companies still struggle to raise capital. And why is that? Because the numbers and the story do not align, right? So, and that is what we will explore today. So, which is the financial narratives that raise money. So, Matteo, welcome back again. Thank you very much for another lecture today, because I think actually this is very impressive what you are telling us or sharing with us. And we are testing that in the field with real founders, real companies, real cases, and we can share with you the finding and how all this is so important for when you're going to raise capital.
Thank you very much, Francisco. This is the narrative about how to speak to an investor about raising money is such an important area in business. It's where you effectively really clinch it, where you go from preparation to real execution. Yeah. And I have to say, because I've been so many years in business, watching so many situations, one different from the other one, happen. I can tell you this is one of the most misunderstood areas in business. Yeah. Because many founders and also many finance professionals, I have to say, they believe that if the numbers are strong, the capital will follow.
Right.
And this is unfortunately a real misconception. Investors do not fund numbers alone. Really, they what they do is they fund narratives supported by numbers. And
Right.
as soon as they see a disconnection between the two, they start to hesitate, and it just takes a very small doubt, a small incongruence to
Yeah.
really lose the opportunity. And that's what really we're trying to do today. We want to
Right.
make sure that doesn't happen to you.
Right.
So,
Right.
because it's such a pity, even if the business is performing well, you're going to lose an opportunity to get funded. So that's really something I'd like to explain well today. Thank you, Francisco.
Yeah. Excellent. Yeah, because this week and last week, I have several conversations with founders looking to raise capital, and you see the pitch decks, you see what they present to you, they have the models, and then you start to think and say, what is missing here? So this is a communication issue, really, or is something deeper? Because actually, when you see the decks and you start to think as an investor, could be institution, could be family office, private equity, venture capital. So what is really missing here that actually, when you are producing this documentation or these decks, what is this? Is it my pitch, the way that I pitch, the information I put there, or is something deeper there?
Yeah, effectively, it's a lot deeper because it's a bit like, when you go into another country and you have to learn a new language. Okay.
Yeah,
So if
yeah,
you've
it's
never
true.
spoken that language before, say, oh, well, I have to learn that language. And so it's really a lot deeper. And I tend to differentiate in between three different language. Most company they speak two languages, but not the third one, which is the investor language. I don't know if that
All right.
makes sense, yeah.
Yeah,
So let me tell you what companies tend to speak. They tend to speak
right,
number one, the operational language of the business.
right,
It's when they describe what they do every day, what the mission is, what they're trying to achieve, yeah, what is their role in the market and etc. So the operational language of the business. Okay, that's quite many people know about this.
right,
The second language is the financial language of reporting. Okay.
right,
So the financial language of reporting is usually when you describe the results, yeah, the
right,
past result, by the way, not so much the future, the future really view on what the business
right,
is going to do. So that language is absolutely fine when it comes to really discussing internally. And to a certain extent, it's also useful for investor, but does not really was going to clinch anything with an investor. The problem is that investors operate in another language, the
right.
language number three.
Yeah,
That language is the language of valuation and capital allocation
right.
because that's where it really makes the money. So
Yeah,
first of all, they want to know where the money is going to go, and secondly, they want to know how that money is going to make a scalable business that is going to increase the value of the money they've invested.
right.
So let's say this, if a company cannot translate its performance into that language, that message is really lost. So we want
Yeah,
to avoid that. Yeah.
yeah. No, I love what you're saying because actually I have your book here,
Thank you.
Fail, Pivot, Scale, that actually explains very well in chapter 2. And one in page 151, what the founders are missing is a very good list of things actually had to be considered in these cases, right? Because I really like what you say about the language or the comparison with the languages, particularly when they say operational, financial, and then you have evaluation and capital allocation, which is a completely different language from what I do and how I operate financially. So it's a different thing. And as I mentioned, we have several conversations this week with companies raising, and I think that they miss that third leg of the conversation and say how they are valued themselves and exactly what is the capital allocation. So where they are going to monetize the organization, how they're going to return that investment, et cetera, et cetera. Even I call it the spreadsheet jockeys because they do very good spreadsheets, but actually seems to be mathematics that actually are formalistic rather than based on realities in contract, letter of intent, et cetera, that start to speak the language of the investors. So when the investor is listening, and back to what the investors' language, when they listen into a pitch, what are they actually trying to understand? Because actually one thing is listening and passing by information. Other thing is actually, I want to understand something here because it's a second implication behind that understanding.
Yeah, I mean, that's a great, great question because what they're trying to answer effectively, I would say it's free. They were trying to answer a free question, okay?
Right.
Let me just put it that way. It's free question, really.
Yeah.
So the first one is, why does this business win?
All right.
They want to know really what makes this business be successful, yeah? Um, but that's not enough because you're winning now. They
Yeah.
want to know. The second question is, uh, why will it continue to win? Because let's face it, it's not about really what you've done and what you want to do. It's about whether the investors has confidence that this will happen in future. Because I put the
Right.
money today to get the result tomorrow, yeah? So you
Yeah.
can tell me that you're winning, but I want to know why you're gonna win in future. So that's
Right.
really, really fundamental. Um, and also the other question is if it's winning now and if it's gonna win tomorrow, okay, there's something else that they want to know. How does this translate into scalable and predictable value?
Right.
Because the concept of scalability, the concept of predictability is that every extra pound, extra dollar, extra euro will generate exponentially more pound, more dollars, and more euro. So you need to be able to explain that these three things, they are very well answered. Okay, so I'm winning. Okay, fine, good. Will you win in
Yeah.
future? Yes, I'm good. How does this really make me more money every time I put more money into this?
Right.
Because don't forget, the investor, when they evaluate your business, they're already thinking about their own exit. Yeah. They're
Yeah.
already thinking, okay, I'm going to put money into this today. I'm going to make money. Then someone else is going to put money after me. Then how will this make sure that it's sellable to someone else in future? So what's the bottom line of this free question that needs to be answered? If the narrative cannot clearly answer those questions, I say all of those questions,
Right.
the investor is going to see risk, yeah?
Right.
And the risk delays capital, and the risk will put a heavy discount on your valuation. So
Right.
that's where people ask me, okay, why did I discount my valuation? Well, because those answers and those questions really have not find the right answer. So in a nutshell, this is what I would say, though every situation is obviously quite unique, but that's what it comes down to.
Yeah. Well, I love these three questions because probably we are, I say, because I made several pitch decks. We show how we win or how we continue to win. We start to decay the narrative there right away. And in terms of scalability and predictability, sometimes you don't see the value real evidently or very evident in the pitch decks on the numbers. It's just pretty much a formula. Um, how where does this disconnect usually? So when you have these three very clear questions, so this is the way that win, this is the way we continue to win, and this is the way to scale. Where exactly is the disconnect? Is it when that happened? Just to illustrate a bit, like I say, listen, if you're listening to this, I say you pay attention to this because this is very important when you're pitching a game.
You're making me think about a conversation at I think it was last week, yeah, with a
Right,
business when they were saying, well, the data room we present to an investor, there was a question that was not covered in numbers. That made me think a lot because, yeah, what you see is that businesses, they prepare document and then they don't reconcile it back to the numbers. The number don't reconcile back to the data, to the document.
right,
So, yeah, you need to read many times back the documents and making sure that the numbers reconcile. So this happens when the numbers really are presented without meaning, yeah? So
right,
the revenue is shown but not explained, or even if it is explained, there is there's disconnection between the revenue and a document that is put together in front of the investor, yeah.
right.
So and that's unfortunately very common, and it's so expensive to do that because you lose a big opportunity.
Yeah,
So growth is shown but it's not contextualized, yeah. Say for
right.
example, you say you're going to grow the business but then you don't really tell in which context you're going to grow. You don't really put the investor in front of the full context. Um, or, for example, the margins are presented, but they're not linked to scalability.
Right.
So even worse, the margin are not calculated in a way that will make the investor think, well, this is how it's going to scale. This is how you're going to go from a certain level of margin to another level of margin, okay?
Yeah,
Uh, So really what happens is the investors, they see data, but the data doesn't really is not followed by logic, yeah.
yeah,
Um, and what happens when you got this disconnection? Without logic, there's no confidence. And when the confidence goes away, there are only two things that can happen. One is discount on valuation, or
right.
two, they abandon completely the pitch.
Yeah,
This is why unfortunately you have to be really sharp in everything you do because
yeah,
uh, capital is really selective, highly
yeah,
selective. You just don't want to miss an opportunity because you haven't read back many times the document that you put in front of an investor, really.
yeah, yeah. And actually, uh, I think it's you mentioned a word here that I really love it. When I heard, I said, yes, that's so many times it's missed, which is context. The growth is not contextualized. It's pretty much, it seems actually everything is a linear or a funneled narrative towards some specific, which is give me money. I'm sorry, I'm oversimplifying this, but actually that sounds like that. And instead of explaining, and they will say, no, but we put the time, we put the sum, we put this, we put the other. They say, yes, but actually it's so broad that doesn't really explain the context of what is your function in this particular activity and the context where you are going to grow, scalable, predictability, etc., etc. So it seems to be so big that actually the context where your specific narrative lose track of the reality. It's like, okay, so I'm lost here. It's like in the ocean when you're not, or in the forest, you are walking or you're swimming, but you don't, where are you going with this? You don't have that context where you're going, where's the destination, even if you don't see it. I love this and the logic of explaining this. So when when this when you have a strong financial narrative, then how it looks like for somebody that is listening and say, listen, if you do this, probably you'll have a better chance to retain the attention of the investors or the capital.
Strong financial narrative.
Yeah,
Yeah, I would say a strong financial narrative usually connects three elements.
right,
So yeah, I just want to make it as a it's really memorable, yeah, for many.
right,
Um, so they are performance drivers and scalability. I'll explain
right.
them, I'll explain them because that it's about connecting those different languages. Like now,
Yeah,
performance number one, will tell you what has happened. So it's the past,
Right.
will tell you what the business has been performing and what it has achieved, yeah.
Right.
But performance on its own does not really matter so much to an investor because let's not forget, the investor is forward looking, is not backward
Yeah.
looking.
Right.
So that's why the second element is drivers. Okay. So what made that performance happen? Okay.
Yeah.
Is that driver gonna be allowing the performance to happen in future as well? So the reason why the performance has been achieved, will that reason continue to be there? Okay.
Yeah.
So that's the second question. But the third one is even more forward looking because it's about scalability. Okay.
Right.
Scalability, comes after the first two. It's okay, well, I can see that the business has performed well.
Yeah.
I can see why. I can see why it performed well. But now I want to know what happens next when the business grows.
Right.
So will the driver continue to lead the performance? Because when these three elements are really aligned, the investor will really follow the story. So
Right.
you're really gonna have their attention when you can really align these three elements together.
Right.
Now, what happens when the story is clear? The confidence increases, the risk is perceived to be lower, the valuation goes higher.
Right.
Okay,
Right.
so it's really a mechanism that with let's say it's quite intuitive. It doesn't seem to be so difficult, but you need
Okay.
to achieve it to make it really, really simple.
Right. Right. So that is pretty much the three levers, or the three levers, like a performance, the drivers, and scalability is why this business win, why we'll continue to win, and how make it scalable. So that's brilliant. And so this, like, how can I put this? This sounds like you mentioned a few things actually quite interesting in terms of the investors don't look backwards, or the backwards thing is pretty much the let's say the foundation where we're having this conversation. Let's put it that way. So what is it? What is the shift from the reporting or auditing the past and the storytelling then, so that will keep the investor looking forward and enthusiastic or attention into what you're in the pitch deck or in the narrative of this capital raising or the company valuation?
I have to say, no, thank you for this question because this is where we can see a major gap, a
Right.
major gap in the finance profession, in the financial profession, really. Because the education that many people have received is about reporting the past, is
Right.
not about creating wealth for the future. That's why
Right.
in 2017, I created this program, which now is part of the book Felt Pivot Scale,
Yeah.
and it's the high valuation triangle.
Right. Right.
Um, Now, it's fundamental that finance professional understand that this is really important for them because there's going to be lots of displacement because artificial intelligence is going to do most of the reporting that now many finance professionals are doing. So you need to act as quickly as possible to ensure that you adapt to this new
Right.
era. Now, traditional finance focuses on reporting the past, as I said, yeah.
Yeah.
But guess what? Financial statement, they tell you absolutely nothing about the valuation of a business, the multiple. You may be thinking, okay, well, I have an EBITDA of 2 million, therefore my valuation is a multiple of 2 million, 2.5, 5 million. But guess what? That that assumption is so wrong because there are so many variations that will take you from a multiple of 2, 2.5 to a multiple of 10, which you will never ever read on a financial statement, because
Right.
it's all about the intellectual property, it's all about succession planning, it's all about the quality of revenue, it's all about the durability of revenue, for example. So strategic finance translate the past into a forward-looking narrative.
Mm.
So this is where the profession needs to really, really change.
Right. Right.
Strategic finance explains how the business creates value. It
Right.
doesn't just tell you what happened. You need
Right.
to explain how do you create wealth. You need to be
Right.
passionate also about the wealth creation process, in my view, to do that. Yeah.
Yeah.
Which is why many people mindset, many finance professional mindset need to really evolve with this.
Right. Right.
How that value scales. Not only it's about creating value, the value has to create scalability.
Right.
And now capital accelerates that process. Now you have defined how the business creates value. You have defined how the value will scale. Now you need to explain to an investor how the capital accelerate that process. Okay.
Right. Right.
This is really what turns number into what I call it investment logic. Okay.
Right.
Investment logic does not need uh, traditional finance. It needs really forward-looking strategic finance. Yeah, that's my
Right.
conclusion on that.
Yeah. Well, thank you for that because I think it's very you highlight a few things actually. I probably people are not fully aware. Um, and you say, well, say, what can I do? That's the education I receive. I have to report the past. I have to audit the past. Nobody's teaching me how to create wealth or to manage wealth or how to plan for wealth. And we have to bear in mind that pretty much all our regulatory requirements and education, universities or professional bodies are I haven't evolved from the past 30 years or and since they were created back in Industrial Revolution. So they were refined, but actually pretty much is a cookie cutter from what happened in the past 100 years. So it's very difficult to do that change. I'm guessing so, but highlighting actually how the economics today, the socials, and the technology. You mentioned AI, like how fast it's changing everything, almost quarter after quarter. We need to rethink things how we do it. So in this investment logic, when you have your CFOs as they put in the traditional way to the CFO, okay, now I'm the chief financial officer. So where they sit in this process now, taking into account all this information that we are sharing.
Yeah, this is where I spent quite a few, we'll say years, really explaining
Right,
how the CFO should be totally different
right,
compared to what many say that the CFO should be. I mean, I would say that the CFO he or she becomes the bridge.
right,
Um, the bridge between what? The bridge between operation and investors. Okay.
right,
I've been in a situation where founders have found capital and then the investor said, you must have a CFO now. And I'm gonna impose that CFO on you if you don't find it, So
right.
um because really this is what the CFO should be doing, yeah? So he or she should be living between data and decision making.
Right.
Okay, so data is obviously you have to live with the past, with the performance, but then it's about making decision, trade-off situation. Now, between performance and valuation, yeah? Because
Right.
performance, again, what we said before, performance is good. It's good that we see that we know it's happened, but you need to
Yeah.
explain why our capital will accelerate performance in future as well. So it's important for CFO to understand this.
Right. Right.
Because a strong CFO will not just produce numbers, especially in AI-driven economies.
Yeah.
That's gone. forget about, just producing numbers. That's not really going to be your job or your main function anymore.
Yeah.
What do they need to do then if
Yeah.
they don't just produce number?
Yeah.
They need to frame the narrative that explains those numbers, yeah? So because AI will do that job,
Right.
let's not really even argue about that. That's something that is already written, and we see it happening every day.
Right.
Now, by framing the narrative that explain those numbers, you are really creating what the investors will rely on. So they will rely
Right.
on the CFO. They will really, they will really indicate, and they will treat the CFO as the real bridge between operation and investor relation. That's really the key.
Right.
That's what I see happening in the future, really.
Yeah.
And it's happening already. Yeah.
Yeah, because it's very true. Like I like the image of a bridge, because really many times CFOs are treating pretty much as a validators of the bookkeepers. Like so, yeah, we have a CFO that have oversaw all the information and yeah confirms that all is correct, but actually a bridge between this information and the investor look forward looking. I think that's a very good evolution. It doesn't mean that there are many people doing it, but in average, you don't see that happening with these experiences that we have just recently, like a couple of weeks ago and last week, with people that are coming with a very auditing style, let's say pre-formatted modeling in terms of 3 years future, 5-year future, and when you have two questions there, they say like, well, that's the model. They don't know how to explain how it's going to scale, how it's going to be part of the context of the environment where they are raising capital, etc., etc. So what happens if companies do not get this right in terms of what we are just talking right now?
Yeah, when company don't get this right, I'll tell you what happened is they experience what I call silent rejection.
Right.
Now, and unfortunately, this is very uncomfortable for many
Yeah.
because because they feel like something they feel like really cool. It's like a cool shower, okay?
Right. Right.
Uh, because okay, the investors they show the interest. They say, okay, thank you very much, and they just show it looks like it's genuine interest.
Yeah.
Um, the meetings they happen, the data is shared,
Yeah.
decisions are delayed, yeah. And that may seem like a big disappointment. Yesterday I spoke to a founder told me, oh, I'm feeling so disappointed about this. But that's
Yeah.
what happens. Um, Now it's not because the business is weak, yeah, but it's because the narrative is unclear. Um, and really what happens when with unclear narratives, what happens is this creates really hesitation. And
Right.
hesitation is is what happens before an investor actual fact, they are 95% really switched off completely.
Yeah.
Obviously, it may sound like, a gentleman approach. Okay, they don't want to say, I don't like your business, but they just go silent and, you never
Yeah.
hear them again.
Yeah. And I'm actually probably, and I have an example that happened yesterday. I have a meeting with a company that they were raising a quite substantial amount of money, and they are in the business of renewable energies. And in the first 5 minutes, I say, of the meeting, I unfortunately switch off in the rest of the pitch because actually I asked one question after the introduction. I said, "Can I ask you one question?" Because actually, so we can go right into specifics. And ask one question in terms of the future, in terms of how this company is going to monetize all the projects that they have, etc., etc. And they were raising a quite substantial amount of money, and everything makes sense, but they couldn't answer this particular question. And when you say the silent rejection, say out of politeness. I know that in other organizations, they switch off right away and they say, okay, this meeting is over, we are not interested. But out of politeness, perhaps in Europe, we are more polite in this sense. And the rest of the hour was just listening to the same story again, their own story. They were not really listening or answering the question or the other question that followed back to the same point. They say how you're going to monetize this in the coming future, even if you have a brilliant business model here. And that's why I think what you just explained, this is a real case, by the way, and how it feels from the side of the people that are looking in or listening to people that are looking for raising. If you don't have these narratives very well structured into the future scaling, that is something that you covered already. The investment team is going to listen and say, okay, fine, thank you very much. And you will go out of that meeting thinking we did a great job, but the money will never hit the bank account, unfortunately, because actually you haven't answered the question. You were too enamored of your own narratives that actually you lose the track of what is really happening in the room. And I guess actually you mentioned something else there with AI, which is how AI is going to help or affect this financial storytelling. Is something that we can look into as the new technologies, how evolving, how AI is going to help these, or how does it affect it?
Yeah, I mean AI is just it's just such a controversial subject for many.
Yeah,
What AI does in this situation is obviously one of the things to bear in mind is that AI readiness is becoming investor readiness. Yeah.
right.
And this is really something that many people have to understand because those who are not very well professionalized, they're gonna find it much more difficult to raise capital, if not
Right,
impossible, I would say. So AI really makes data more accessible, much more easily, but it does not automatically create clarity. Uh, in fact, it can actually create more noise,
right.
especially in a not truly professionalized environment. It will actually create more problem than it will
Yeah,
solve. Um, so the advantage will not come from having more data at all. It will come from having a clearer narrative built on that data. Okay.
right,
So it's you need to be right up front before you create more data. So that narrative needs to be really absolutely reconciled with the data. There has to be a total a total alignment between narrative
right,
and data. Because the investor will spot immediately something that doesn't reconcile well, it will become a reason for loss of confidence. And
right.
the companies that win will not be those with the most information. Absolutely not. Yeah.
Mm,
But those with the most coherent interpretation of that information. And I
yeah,
would really underline that word coherent because too many situations I see, even in highly operational situation, like even when you do a construction finance, a bank will potentially, well, will give you a drawdown, and then
yeah,
suddenly they read the document and the financial forecast they do not align with the document, and
yeah,
everything stops. So yeah,
yeah,
coherence is really underestimated as a word that is important in the investment world.
yeah. And yeah, I love that word coherent. But actually, I just something I remembered just from your book, Fail, Pivot, and Scale. On chapter 2, particularly about this topic, there is a full self-assessment that any company, CFO, or a team that is raising capital can do for themselves on page 159. And for example, one of the questions is, I've identified a repeatable, result-driven method or system in my business. So this is something actually is part of the I like this question, this part. Is this the first one in the checkbox? How many things here? We have like 2 pages of checkbox in the self-assessment of chapter 2 of the book. And why I like this particular one, because it really start to bring together all this information that we're discussing today, because you have to start to document not only how you win, only why you won already in the past, and how is the repeatability, I think, is a key word here, because it's also future looking, which is something that investors are very keen to see. And Matteo, one question, because I think that is quite, if somebody is reading just or watching this episode isolated, you will say, well, there's 12 episodes here. But actually, if somebody say, well, I would love to have somebody just watching my shoulder as I go through this process, what would you, there's a high valuation sprint that actually is a classroom, if you made, where we explain all this in details in all the sequence, in the correct sequence, because information sometimes is difficult to interpret because you don't have the right sequence, and how to apply that sequence in your business. So which is a high valuation sprint, or what is the high valuation sprint?
Yeah, the evaluation sprint comes from the acknowledgement that for businesses to become chased by the three people who are going to put money in your bank account, you know,
Right.
you want to be chased by customer. They're going to put
Yeah.
money in your bank account over and over again. You want to be chased by investor. They're going to put money in your bank account when they obviously agree with you on your story.
Yeah.
Number three, banks as well, banks, because many
Yeah.
people don't understand banks. I always say, if you speak to a bank like a customer, you're going to be charged like a customer. But
Right.
if you speak to a bank like an asset, you're going to be funded like an asset,
Right.
you know? So what the evaluation sprint is has created is the acknowledgement that there are 12 outcomes.
Right.
Those 12 outcomes that, if achieved, will make your business chased by those who are going to put money in your bank account.
Right.
So it's 12 outcomes achieved in 49 days. And those 12 outcomes, they will be part of a program that will go for 8 weeks. So
Right.
the first between the first and the 8 week, there's going to be 49 days, you know.
Right.
What are the 12 outcomes we're going to achieve together? Number one, we're going to understand why capitals say no. Number two, we're going to build IP, intellectual property driven value.
Right.
Number three, we're going to design scalable revenue.
Right. Right.
Number four, we're going to remove founder dependency. Number five, we're going to build leadership and governance.
Right.
Number six, we're going to create financial narrative that raise capital as we're speaking today.
As we're speaking today, yeah.
Number seven, we're going to engineer capital structure. Number eight, we're going to prepare for international growth. Number nine, we're going to build resilience, which is not just a motivational word. We're talking about financial resilience and operational
Right.
resilience, yeah. Number 10, we're going to design exit strategy, and exit strategy is absolutely relevant for this, even if you're never going to exit your business or if you're going to exit in 10 years' time. Number 11, you're going to expand valuation multiple. You're going to go from low multiple to high multiple.
Right.
Number 12, we're going to capture value in deals. That could be exit, that could be mergers and acquisition, that could be even everyday negotiation with your
Right.
customer as well. So this is what we are offering with the evaluation sprint. Is not going to be for too many people because we need to really restrict the number of people that
Yeah.
can join this program. So if you're really interested, please write sprint in the comment below, and we'll come back to you immediately with frequently asked question FAQ, and then we're gonna talk to you about how the program works, how
Yeah.
you can start, and now you're gonna be able to join this program. We're gonna really run several programs. So one starts on the 8th of April. And then there's another could start in April, but the one after April is going to start potentially in July. So if you
Right.
really want to be upfront, you want to be really serious about achieving those 12 outcomes and making your business chased by customers, by banks, and by investor,
Right.
tell us immediately, and we'll get back to you within just minutes, I would say, as quickly as possible. So we got up to 25 businesses that can be accepted for April for now.
Right. Fantastic. Excellent. Thank you, Matteo. And I think that actually this closed today's session, number 7. And for next week, we are going to talk about engineer capital structure, because actually it's not just about the narrative, also how you structure your capital, right?
No, thank you, Francisco. And if there's one idea to take away from today, I think is this, yeah.
Yes, please.
Many people think, okay, investor will fund numbers. Really, what they fund is not numbers. They find confidence in the story that those numbers will tell. It's
Right.
very, very different. Yeah.
Yeah. Excellent. Wonderful. So we'll catch up next week then.